Something is happening in the silver market right now that most people are completely unaware of. And the reason they don't know is not because the information is hidden. It's because the data is sitting in plain sight, buried under headlines about gold, buried under noise about crypto, and buried under the assumption that if something serious were really happening, someone on the news would have told them by now. They haven't. So if you've been following silver for any length of time, stay with me, because what's building right now is unlike anything the market has seen in decades. And if you're new to this topic, what you're about to hear is going to fundamentally change the way you think about one of the most overlooked assets on the planet. If this kind of deep financial analysis is what you're looking for, hit that like button right now and subscribe to Silver and Gold. We cover what mainstream finance ignores. Now let's get into it. Here's where we need to start. Every few years, a shortage story makes the rounds in the silver community. Prices spike, social media explodes, and then nothing happens. The shortage doesn't materialize, prices fall back, and people walk away concluding that silver shortage talk is always hype. That conclusion has become one of the most dangerous assumptions in investing today. Because here's what most people don't understand. There is a critical difference between a price shortage and a physical shortage. A price shortage is when demand spikes fast and supply can't keep up temporarily. That's what happened in early 2021 when retail investors rushed silver. It was real, but it was short-lived. A physical shortage is something far more serious. It's a structural, ongoing, multi-year gap between how much silver the world consumes and how much the world is actually producing. That second type of shortage doesn't make headlines. It builds slowly, quietly. And by the time the mainstream world notices it, the opportunity is already gone for most people. The silver market has been running a physical supply deficit for 3 consecutive years. That means global silver consumption has exceeded global silver production every single year since 2021. And according to industry data from the Silver Institute, 2023 marked the second largest deficit ever recorded in the history of modern silver tracking. Let that sit with you for a moment. Not a one-year spike, not a temporary imbalance. 3 consecutive years of consuming more silver than the world is mining and refining. Now here's where it gets really interesting. The demand side of this equation is not being driven by investors. That's the part that surprises most people when they first look at it. The dominant force consuming silver right now is industry, and not just any industry. It's the same industries that governments around the world are pouring trillions of dollars into accelerating. Solar panels, electric vehicles, advanced electronics, military technology, medical devices. Let's take solar energy first because the numbers here are staggering. A single solar panel uses a small but very precise amount of silver in its electrical contacts. Silver is one of the best electrical conductors on Earth, which is why there's no practical substitute for it in photovoltaic technology at the scale needed. Now multiply that small amount across the hundreds of millions of panels being installed globally every year. In 2023, the solar industry alone consumed over 200 million ounces of silver. That's roughly 1/5 of total global silver production going into solar panels in a single year. But that's not the alarming part. The alarming part is where solar installation numbers are heading. Countries across Europe, Asia, and North America have committed to dramatic expansions of solar capacity over the next decade. The International Energy Agency projects global solar capacity additions to more than double by the end of this decade, compared to where they were just a few years ago. That means silver demand from solar alone could increase by tens of millions of additional ounces annually, just from projects that are already funded and planned. Here's where the situation becomes much bigger. Solar is only one piece. Electric vehicles are the other industrial force reshaping silver demand in real time. EVs use silver in charging infrastructure, in battery management systems, in circuit boards, and in the advanced driver assistance systems that are becoming standard on virtually every new vehicle. Some estimates put the silver content per electric vehicle at 2 to 3 times the silver used in a conventional internal combustion engine vehicle. Global EV sales have been setting records year after year. In 2023, more than 10 million electric vehicles were sold globally. That number is expected to grow dramatically through the end of this decade as governments phase out combustion engine vehicles and automakers retool their entire production lines for electric platforms. Now think about what this means combined with solar. You have 2 of the fastest growing industries on Earth, both requiring silver in quantities that have no viable substitute, and both being subsidized and mandated into existence by government spending at a scale the world has never seen before. And then there's the supply side. And this is where the story takes a turn that most people are completely unprepared for. Here is the detail most people miss when they talk about silver supply. Silver is not primarily mined by silver mining companies. Roughly 70 to 80% of silver produced globally comes as a byproduct of mining other metals. Copper mines, lead mines, zinc mines, and gold mines all extract silver as a secondary product. This means that silver supply is not directly controlled by silver demand. It's controlled by the economics of other metals markets. When copper prices are high, copper miners produce more, and silver supply increases as a byproduct. When copper demand slows, miners pull back, and silver byproduct production falls. The silver market has almost no mechanism to increase primary supply quickly in response to rising demand the way other commodities can. This structural reality means the silver market cannot simply respond to a shortage the way a normal market would. You can't build 5 new silver mines and fix the problem in a year. Primary silver mines take 8 to 12 years from discovery to production, and the pipeline of new silver projects globally is thin. The Silver Institute data shows that primary silver mine production has essentially been flat for several years. The new projects coming online are not large enough to offset the growing demand gap from industrial applications. But that alone would be significant enough. There's something else happening that almost nobody is talking about. Above-ground silver stockpiles are being drawn down at an accelerating rate. For decades, the silver market relied on large, above-ground inventory to bridge the gap between production and consumption when deficits occurred. Government strategic stockpiles, industrial inventory, and ETF holdings all served as a buffer, but those buffers are not unlimited. COMEX registered silver inventories, the silver available for immediate delivery on the major U.S. commodity exchange, have experienced significant drawdowns over the past several years. At various points in recent history, the ratio of paper silver contracts to physical silver available for delivery has reached levels that would have been considered impossible just a decade ago. This is the part of the silver story that makes experienced commodities traders deeply uncomfortable, because paper markets can function normally right up until the moment they can't. And when a commodity market faces a genuine delivery squeeze, the price adjustment can happen very fast. Now here's a question that changes the entire analysis. If the fundamentals are this clear, why hasn't silver already exploded in price? This is the question that causes a lot of people to dismiss the entire narrative. They look at the data, they agree it seems compelling, and then they look at the silver price and say, if this were real, the price would already reflect it. There are actually several legitimate reasons why silver price has lagged these fundamental developments, and understanding them is critical. First, the silver market has a massive paper component. Futures contracts, ETF shares, and other derivatives represent far more silver than physically exists in deliverable form. This creates a mechanism where paper supply can temporarily absorb demand pressure without the price reflecting physical tightness. Second, large institutional holders of silver have been gradually liquidating positions over several years, adding supply to the market that temporarily offsets the physical demand surge. But this process is not infinite. Those positions don't last forever. Third, and perhaps most importantly, financial markets are forward-looking, but they require a catalyst to reprice. The silver market needs a visible trigger, and there are several potential triggers building right now that could serve that function. The most significant one involves a development that could directly affect paper silver markets in ways that have never been tested before. There is a quiet but important movement happening among major commodity-consuming nations to take physical delivery of metals rather than holding paper contracts. China, India, and several Middle Eastern sovereign wealth funds have been accumulating physical silver and other precious metals in ways that go beyond normal investment behavior. When large institutional or sovereign buyers begin converting paper positions to physical delivery, it puts direct pressure on exchange inventories. And with COMEX registered silver inventories at historically low levels relative to the outstanding contracts, the math here becomes uncomfortable very quickly. Industry analysts who track these flows have noted something unusual in 2023 and continuing into 2024. The gap between silver's spot price and the premiums being charged for physical silver in certain markets has been wider than historical norms would suggest. Physical silver coins and bars in various markets have been trading at premiums that reflect a tightness in supply that the headline spot price doesn't fully capture. This kind of premium divergence is one of the earliest signals that a paper market is beginning to lose its anchor to physical reality. And if you understand how commodity price discovery works, you understand why that signal matters. At this point, let us know in the comments. Are you already holding physical silver, or are you just beginning to look at this space? Tell us where you are. We read every comment. Let's talk about what comes next, because the forward picture is where the stakes get very high. Silver has a dual nature unlike any other commodity on Earth. It is simultaneously an industrial metal that is consumed and destroyed in manufacturing processes, and a monetary metal that has served as a store of value for thousands of years. Most commodities are one or the other. Silver is both. This dual demand structure means that in a period of rising industrial consumption and monetary uncertainty, silver faces demand pressure from two entirely different sources simultaneously. Industrial buyers need it to build solar panels and electric vehicles. Monetary buyers and investors want it as protection against currency debasement and economic instability. When both forces are pulling in the same direction at the same time, while supply remains structurally constrained, the resulting price dynamic can be violent and fast. History gives us a reference point here. In 1979 and 1980, silver moved from under $6 an ounce to nearly $50 an ounce in a period of roughly 18 months. The supply and demand fundamentals driving that move were not as compelling as what exists in the silver market today. That move was primarily monetary. What's building now has both the monetary component and an industrial demand component that simply didn't exist in 1980. This is not a prediction. It's a framework for understanding what happens when a tight physical market meets a sudden recognition event. And there's one more piece of this puzzle that brings everything together in a way that should matter to anyone watching this video. The silver to gold ratio. This is the number of ounces of silver it takes to purchase 1 ounce of gold. Historically, this ratio has averaged somewhere between 50 and 80 to 1 over the past century. During periods of genuine silver price discovery, during periods when silver's true scarcity becomes reflected in the market, this ratio has compressed dramatically. At points during this cycle, the silver to gold ratio has been above 80 to 1. Some brief periods have seen it approach 100 to 1. What this means in practical terms is that silver is historically cheap relative to gold. Not just slightly cheap, historically cheap by almost any measure. When this ratio was at similar levels in 2020, silver subsequently moved from roughly $14 an ounce to nearly $30 in a matter of months. The ratio compresses when silver starts to catch up, and every major bull cycle in precious metals history has included a phase where silver dramatically outperforms gold. We are sitting at the beginning of what could be exactly that kind of phase. The fundamentals are in place. The structural deficit is confirmed. The industrial demand drivers are not going away. The paper market has vulnerabilities that haven't existed at this scale before, and the ratio signals a deeply undervalued asset. So let's bring this all the way together, because there's a larger picture here that matters beyond just the price of silver. We are living through a period of accelerating industrial transformation. The electrification of transportation, the scaling of renewable energy, the expansion of advanced electronics and military technology, these are not trends that reverse. They are policy commitments backed by trillions of dollars across the world's largest economies. Every single one of these trends increases silver demand. None of them decreases it. At the same time, the supply side of silver has structural constraints that make rapid response to higher demand nearly impossible. Mining timelines are long, new discoveries are rare, byproduct supply is tied to other metals markets beyond silver's control. And then there is the monetary layer. In a world where governments are running historically large deficits, where central bank balance sheets are at unprecedented levels, and where confidence in fiat currency management is under pressure globally, precious metals occupy a position of strategic importance that hasn't been this relevant in decades. Silver sits at the intersection of all of these forces: industrial necessity, monetary relevance, structural supply constraint, historical undervaluation. The shortage that nobody believes is already happening, and it is happening quietly, methodically, in the data, in the inventories, in the widening gap between what the world needs and what the world can produce. The question isn't whether this story resolves. The question is whether you understand it before the market does. That's the question we want to leave you with today. If everything we've walked through in this video is accurate, and the data strongly suggests that it is, what does that mean for how you think about your financial positioning over the next several years? We want to know your answer. Drop it in the comments right now. Are you already positioned in silver? Are you skeptical of the thesis? Tell us why. This channel exists for exactly this kind of conversation. If this analysis gave you something valuable, something you didn't fully see before watching, please share this video. Share it with someone who follows markets. Share it with someone who's been watching gold but hasn't looked closely at silver. The information here matters, and most people are not going to find it through mainstream sources. Like this video if you want more analysis at this depth. Subscribe to Silver and Gold so you don't miss what we cover next. We are tracking this silver story in real time, and the next developments in this market are going to move fast. The shortage nobody believes is real. The only question that remains is how long it takes for everyone else to figure that out.